Welcome back to the deep dive. Today, we're getting into something I think is really fascinating: seller financing.
Yeah, it's definitely more than just, a way to close a deal. It's often a much smarter financial strategy, especially for the seller.
Right, and we've got some great material guiding us today, really digging into the core ideas, the benefits, and importantly, the tax side of
And
things.
also how to actually, well, talk about it effectively, how to pitch it as a solution.
Exactly. So, our mission today is to really unpack this, not just the what of seller financing, but the why it's so good for sellers and the how you make it happen.
Okay, let's dive in.
So, the basic idea is seller financing. The owner essentially becomes the bank, right? They hold the mortgage.
That's the core of it.
Mm.
And understanding the tax piece here, well, that's not just the detail. It's a really powerful tool. It can honestly change the whole game for the seller.
So, what makes it so powerful from a tax perspective?
Well, it really revolves around this concept called the installment sale method. This is probably the single biggest reason an owner would seriously consider seller financing.
Okay, installment sale method. How does that differ from just a normal sale?
In a typical sale, you sell the property, you get the cash, and boom, you owe capital gains tax on the entire profit in that same year. It can be a huge hit all at once.
Right, a massive tax bill suddenly appears.
Exactly. But with an installment sale, the seller gets to defer a big chunk of that tax. They only pay tax on the portion of the profit they actually receive each year.
Ah, okay, so it spreads it out.
Precisely. Let's take an example. Say someone sells a property for $1 million and their profit, their capital gain, is $500,000.
Okay.
In a normal cash sale, they owe tax on that full $500,000 right away. That could easily push them into a much higher tax bracket for that year.
Yeah, that makes sense. A big income spike.
But if they do seller financing, maybe they get a $100,000 down payment the first year and then, say, $50,000 in principal payments each year after that. They only pay tax on the profit portion of that $100,000 in year one, and then the profit portion of the $50,000 each subsequent year.
So the tax liability tracks the cash they actually receive.
Exactly. It spreads the income, which means it also spreads the tax liability over many years, and crucially, it might keep them in a lower overall tax bracket each year.
So what does this really mean for the owner? I mean, beyond just spreading payments, what's the core advantage for them or for you if you're structuring this?
It fundamentally gives the owner control over their tax timeline. It turns what could be a single, potentially painful taxable event into a much more manageable, predictable flow over years.
Instead of one big tax hit, it's smaller, planned amounts. That sounds like a huge stress reliever.
It absolutely can be. It changes how they experience the financial result of the sale. It's planned, it's smoother.
Okay, so that's the core deferral benefit. Let's maybe drill down a bit more on the other specific tax advantages for the seller.
Sure. So benefit number one is what we just discussed, deferred capital gains. Spreading that tax burden over the loan term instead of one massive hit makes managing their money much easier.
Right. And you mentioned the tax bracket. How significant is that aspect?
Well, that's benefit number two, potentially a reduced tax rate. Because they're not getting that huge lump sum inflating their income in one year, they're less likely to get bumped into a higher marginal tax bracket.
So by spreading it out, they might actually pay a lower percentage in taxes overall on the same amount of profit.
It's definitely possible, yes. They avoid that peak income year hitting the highest rates. They keep more of their money over the long run.
Okay, that's compelling. And what about the cash flow itself? You mentioned it's tax advantaged. How so?
Right. Benefit three, steady tax advantage cash flow. The monthly payments they receive act like a predictable income stream. It's passive. And the key is, only the principal portion contains profit, and only that profit portion is taxed each year as it's received.
Ah, okay. So the interest they receive is taxed as ordinary income, but the capital gains tax is only on the profit part of the principal payment.
Exactly. It provides financial stability, turns the sold asset into this reliable income generator, but without the day-to-day headaches of managing the property. It's a very tax-efficient way to structure income.
Got it. And there was a fourth point, something about recapture.
Yes, recapture taxes. This is a bit more technical, but important. A savvy owner knows that when they sell, they usually have to pay back or recapture some of the depreciation deductions they took over the years. It's taxed at a special, sometimes higher, rate.
Another potential tax hit at closing.
Yes. But with the installment sale method, This recapture tax can also often be paid over time, usually front-loaded in the early payments, but still spread out somewhat, softening that immediate blow.
So taking it all together, seller financing lets the owner kind of choose, within limits, when they pay their taxes.
That's a great way to put it. It transforms the sale from just a transaction into a sophisticated financial planning tool. It can save them significant money, reduce stress. Honestly, it can function like a long-term, tax-efficient retirement plan.
This really does shift the perspective, doesn't it? It's not just about getting payments. It's about strategic financial management.
Absolutely. These are really compelling benefits.
No, we absolutely have to include the standard disclaimer here, right?
Oh, yes. Crucial. This is all for educational purposes. Anyone considering this, especially the seller, must consult with their own qualified tax professional or CPA.
Definitely. Get personalized advice for their specific situation, non-negotiable.
Couldn't agree more.
Okay, so we've got the installment method, the benefits, the tax savings, the peace of mind, and the why. It's a smarter financial strategy. But now, the how. How do you actually bring this up? How do you pitch it?
Right, because having the knowledge is one thing, but deploying it effectively is another. This process we're about to discuss, it's really the bridge from understanding the concept to actually, getting a deal done this way.
So let's walk through it. Step one seems to be all about timing, the setup.
Yes, and this is so critical. You almost never lead with seller financing. It's not your opening move.
Why not? Seems like a benefit. Why hide it?
Because if you bring it up too early, it sounds like you need it.
Right.
Like you can't get traditional financing. It frames it as your problem, not their solution.
Ah, okay. So you need to wait. When do you bring it up?
You bring it up after you've really understood their pain points, what they want out of the sale, and ideally after you've gotten some kind of conditional agreement that, yes, selling and moving on would make their life better, usually later in the conversation.
Makes sense. Earn the right to offer the solution. There's a suggested line here. It's clear you've worked incredibly hard. Biggest priorities are fair price and hassle-free exit. If we could show you a way to do both, would you be open to hearing us out? That feels very collaborative.
Exactly. It's an invitation based on their stated goals. Once they say yes to that, then you move to step two, the pitch, focusing on the why for them.
And the key here is framing it as a solution, not a request.
Absolutely. You position it as their best option. The suggested language is good. There are a few ways to structure a deal, but what we've found most beneficial for owners like you is seller financing. It's a smarter investment.
Yeah.
Become the bank. Keeps your investment working without headaches. Saves you on taxes.
That really reframes it. It's about their financial health, their ease, their tax savings. It's positioned entirely for their benefit.
That's the goal. It shifts the whole dynamic. You're offering a strategic advantage.
Okay, so they're open. They've heard the why. Now you need to make it concrete, right? Step three. Offer, the numbers.
Yeah, time to make it real. You need to clearly outline the key parts of the offer. Be prepared, be confident.
Things like down payment, like 15, 20%.
Yeah, something solid up front.
Yeah.
Then the interest rate needs to be fair, maybe 6.5% to 8.5% on the balance, so they're getting a good return.
And the term. How long the payments last.
Often, something like a 10-year term works well, giving them that steady income for a good chunk of time. And, of course, the overall total sales price.
And the approach here is also respectful. We'd like to make you an offer we believe is fair and a great long-term decision for you. Here's what it would look like. Then lay out the details.
Exactly. It shows you've thought it through from their perspective.
Okay, offers on the table. Now comes maybe the trickiest part. Step 4. Handle objections and secure commitment.
Yeah, you have to be ready for objections. They might say, I just want all my cash now, or worry about you making payments, the risk. Or maybe they think they need to fix the place up first.
So how do you handle those?
You don't argue, you reframe. If they want all cash, you gently bring up the tax implications again. If they worry about risk, you talk about the down payment, the property itself as security, maybe your track record. You use practiced, thoughtful responses.
And the goal here isn't necessarily a signed contract on the spot.
Not usually. The immediate goal is to get a verbal agreement on the concept. You want them to say, yes, that structure makes sense for me. You need conceptual buy-in first.
And that closing question is interesting. Does a stress-free monthly income and the peace of mind that comes with it sound like a good fit for your retirement plan? That really focuses on the deeper motivation, doesn't it?
It does. It connects the financial structure directly to their life goals. Security, simplicity, retirement. It helps you understand if you're really hitting what matters most to them, beyond just the price.
So there we have it. When you really understand seller financing and how to present it, it moves way beyond just a transaction. It becomes this really powerful tax-smart strategy for both financial planning and retirement.
Absolutely. It just shows how understanding these kinds of tools can really empower both sides of a deal, sellers and buyers, to reach their goals with, frankly, more control and a lot less stress. It changes how you can think about managing wealth and assets.
It really does. So final thought for everyone listening. Considering everything we've unpacked about the installment method, the tax benefits, and the art of pitching it, how might understanding seller financing truly reshape how you think about financial negotiations or long-term wealth management, whether you're the one buying or the one selling?
Something definitely worth thinking about.
Thank you for joining us on this deep dive.